Hello and welcome to Quantum Advisory's Investment Vodcast for Q2 of 2023. In this presentation, we will provide a brief market summary, discuss the economic developments which occurred over the quarter, and provide an outlook of what's to come, considering some of the possible short and medium-term outcomes. Firstly, I will provide a quick summary of the investment market for the second quarter of 2023. As this slide shows, markets generally saw positive returns over the quarter. Japanese equities delivered the highest returns out of major equity markets, delivering a return of 15% over the quarter and 23% in local terms for the year so far. This was due to the yen weakening versus other major trading partners, the economy benefiting from a post-COVID recovery, as the Japanese economy was relatively late to reopen after the pandemic, and the country's drive towards improved corporate governance. US equities also performed well and were up 9% over the quarter. The positive performance of US equities was driven almost entirely by the largest growth stocks, think mega cap tech stocks, which are disproportionately found in the US market. Outside of Japan and the US, other equity markets did not perform as favourably over the quarter. However, over the year to date, European stocks delivered a healthy return of 14%. Emerging markets saw muted returns as a result of the diminishing optimism surrounding China after its initial reopening-driven rally. Looking now at UK fixed income, the story was a lot less positive during the quarter. UK gilts had the poorest returns, delivering negative 8% over the quarter and negative 6% in the second half of the year. Consistent high inflation rates within the UK has led some participants to price in a higher peak interest rate, causing gilts to sell off. Now we will take a look at equity markets, both UK and global, over the second quarter of 2023. As shown in the graph, global equities continued to make gains during Q2 and generated a return of circa 7.3%. UK equities, however, were down 0.3% after posting positive returns over the previous two quarters. Markets started the quarter off strongly, with global equities seeing markets react positively to resilient corporate earnings in April. May saw weaker returns for global stocks, but there were noticeable differences between market sectors, as technology stocks saw strong gains as a result of investor enthusiasm regarding artificial intelligence. The UK equity market had a sound start to Q2, posting positive returns in April, driven by the banking sector, which recovered in line with global trends after the fears surrounding the banking crisis in Q1 receded. Performance dropped in May and June, which was in large part due to a broad-based weakness in commodity prices, and as a result, large UK-quoted diversified energy and basic materials groups suffered. This graph illustrates the changing gilt yields and index-linked gilt yields over the last 12 months, with the most recent quarter highlighted in green. The UK fixed income markets delivered negative returns and significantly underperformed its counterparts, with the UK 15-year gilt index returning a negative 8.3% during the quarter, and the over 5-year index-linked gilt index returned negative 7.8%. UK gilt performance suffered as a consequence of inflation rates declining more slowly than initially expected. This has forced the Bank of England to increase rates more aggressively over the quarter, and the market subsequently pricing in a highest interest rate peak as a result. Following the 50 basis point rise in June, however, UK gilt yields did initially fall, suggesting investor optimism that the bank would be able to tame inflation. However, recessionary indicators began to flash for the UK as a result of the expected higher peak in interest rates. We will now give a brief economic update with a specific focus on the UK economy. Inflation remains a key risk factor over the second quarter for most major economies. In the US, inflation dropped to 4% in May, leading the Federal Reserve to announce in June that it would be putting a pause on interest rate rises, leaving rates steady in the range of 5 to 5.25% after more than a year of consecutive rate increases. US inflation continued to fall in June, reaching 3% by the quarter end. In the EU, inflation fell to 5.5% in June. its lowest level in over 12 months. UK inflation came in at 7.3% in June. Although falling, it still remains high and over 3 times the Bank of England's 2% inflation target. Primary drivers for the fall in UK inflation were interest rate hikes, a fall in food and non-alcoholic beverage prices, and lower fuel prices. However, concern remains in the UK over the stickiness of core inflation numbers. Now looking at interest rates. As previously mentioned, in an effort to curb the elevated level of inflation, the Bank of England increased interest rates to 5% over the quarter. As a result of these rate rises, we have started to see inflation slightly cooling, albeit at a slower pace than other developed economies. Looking at the 20-year gilt yield, as covered on the previous slide, gilt yields rose somewhat steadily during April and May, but there were 2 noticeable falls in yields during the quarter, both of which were due to interest rate hikes of 50 basis points by the Bank of England. The fixed 20-year gilt yield finished the quarter at 4.5%, up from 3.9% at the end of Q1. You can see the UK GDP graph in the bottom right. UK GDP was up 0.2% in April, which is reassuring news considering the recession expectations surrounding the UK. Rising car sales and consumer spending in the UK's large service sector, specifically in bars and pubs, facilitated the recovery from the previous months, where month-on-month GDP fell by 0.3%. This slide shows the sector GDP breakdown for the UK from April 2019 to April 2023, which gives us an idea of economic growth. The graph shows the longer-term changes in output for the agriculture, production, construction and service sectors. As said in the previous slide, the UK is a predominantly service sector-based economy, and therefore UK GDP tends to closely follow the output of the services industry, both of which have remained relatively flat over the last 12 months. The services sector has the largest growth in April, growing by 0.3% after 2 consecutive months of negative growth. Agriculture also grew during April by 0.1%. The construction sector saw the largest fall in April, down 0.9% from March. The ONS has warned signs of stress are emerging under rising rates and falling property values, which is negatively impacting estate agents and housing developers. On the right-hand side of this slide is the International Monetary Fund's growth forecast for the year ahead. The IMF forecasted that global growth will fall from 3.4% in 2022 to 2.8% in 2023, before rising slowly and settling at 3% in 5 years. Developed economies are set to see especially pronounced growth slowdowns from 2.7% in 2022 to 1.3% in 2023. The dampened outlook reflects tighter global monetary policies which are necessary to bring down inflation, the ongoing war in Ukraine, and the fallout from the recent deterioration in financial conditions. Risks to the outlook are heavily skewed to the downside. For example, financial sector stress could rise and contagion can take hold, or the war in Ukraine could intensify at any moment, causing energy and food prices to spike. In these scenarios, global growth could decline further, and the risks of a hard landing for global economies increases. Whilst the IMF forecasts global inflation falling from 8.7% in 2022 to 7% in 2023, mainly due to a fall in commodity prices, underlying core inflation is proving sticky and expected to fall more slowly. These factors represent significant short to medium term headwinds, which we will continue to monitor in the coming quarters. We will now discuss the outlook over the short and medium term. Moving to our outlook as at July 2023, Quantum is neutral on developed equities, as although developed equities can hedge against inflation, the effects of higher interest rates and tightening financial conditions are hitting major economies, with recession risk increasing. We believe that stock selection is key given the stagflation and geopolitical risks, favouring companies with more resilient pricing power and stronger supply chains. We are also neutral on emerging market equities. Emerging market economies have underperformed developed markets due to the concerns around China's economy. While emerging market inflation may now be past its peak, significant risks remain, including the outcome of the Russia-Ukraine war. Rising tensions between China and the West could also lead to a shift in production and supply chains over the medium term. Consideration must still be made in the terms of regional selection, whereby regions that are less exposed to the war in Ukraine and inflationary pressures are better positioned for the future. With regards to the UK government bonds, we have a positive outlook as yields have risen significantly since the beginning of 2022. As a result of this, gilts look attractively priced at their current levels. In addition to this, gilts remain a good hedge for pension scheme liability risks. It is important to note, however, that downside risks remain. This is especially true given the uncertainty of the level of inflation and the Bank of England monetary policy. We have also a positive outlook on corporate bonds. Despite the headwinds that are present, such as rising inflation and default risk, we think that short-dated investment-grade credit remains compelling and has the potential for outperformance relative to their government counterparts. They also remain a useful source of income for pension schemes. Quantum has a neutral outlook on UK property, as inflation, rising interest rates and economic headwinds have increased supply and placed downward pressure on valuation and returns. Shorter-term issues, such as valuation markdowns and rental renegotiations, while sector-specific, will therefore continue to weigh on the sector. Properties with poorer tenants are also more exposed, particularly in the current inflationary environment. Opportunities in industrial sectors, such as warehousing, have been key return drivers due to the switch to e-commerce. We, however, remain cautious on shorter lease properties, where tenant quality and flexibility remain key. Finally, we have a positive outlook on private market, which remain an attractive alternative asset class and provide access to illiquidity and complexity premiums. Private credit has become more attractive as global yields and credit spreads have risen. They can provide an effective hedge against inflation due to the floating rate coupons. They also offer a senior position in the capital structure and higher levels of income with low volatility. Looking at infrastructure, the transition to a low-carbon economy and the energy crisis has led to opportunities, both for equity and debt investors, particularly in renewables and clean technologies. However, diversification across asset classes, regions, vintages, and issuers remains key. Thank you for listening to Quantum Advisory's quarterly investment vodcast. We hope this edition has been informative and provided you with a useful update on the current economic climate. If you would like to discuss any of the topics raised in more detail, then please get in touch with your Quantum contact. Once again, thank you and goodbye for now.